Latha will be speaking with, I think she caught up with Chetan Ahya, Chief Asia Economist, Morgan Stanley, on the sidelines of the Morgan Stanley India Conference to talk about the health of the global economy and how it can impact the Indian market. She began by asking about US economic data and the likely recession in that market later this year. Listen in.
We think that the US economy is most likely on track for soft landing. We think that there are two aspects of the business cycle in the US that will help achieve soft landing and not a deeper recession. And that is, number one, corporate and household balance sheets are in a pretty good shape. And number two, in the labor market, we don't have a starting point where corporate sector has overhired. So if you look at the job openings as a percent of total employed plus unemployed, that is still meaningfully higher than where we were pre-COVID. And in terms of the corporate and the household balance sheets, they are not the ones which have caused too much misallocation in this cycle.
Okay, so it should not be too hard, a landing. It should be more of a soft landing, it would be your guess. Not a deep recession. Okay. Right. Okay. The other trouble spot or worry spot for the global economy has been China. Last few data numbers, industrial output in industrial production, they call it, in April, retail sales, imports, all of them indicated a very slow economy. Should we worry that it's not going to come up to the 5.5, 5.7 that you are forecasting for that economy?
Yeah, definitely there is a risk that we may not be able to get to 5.7, but that's not our base case. Our base case is that there will be that recovery that will broaden out in China. And we are expecting policy easing to support growth in the second half. But let me just parse the story a bit in detail for you. So China's consumption recovery is pretty much going on track. Like in India and other parts of the region, the way we saw the consumption recovery pan out is initially it starts with services sector, and then the goods sector joins. And initially we start with mid to high income segment, and then the low to middle income segment joins. So China is on track to follow the rest of the region on that front, and we don't see anything in the data that worries us on that front. But the part which is surprised on the downside is the investment side. And within the investment side, it's really the real estate fixed asset investment that has a surprise on the downside, and that's acting as a drag. So when you're looking at manufacturing and industrial production numbers that you referred, that's heavily influenced by what happens to the investment spending. And we think that that's something that the government can manage. And that's why we are now expecting that they will take up stimulus measures to support the real estate sector, and they will also announce some support to the infrastructure sector.
Let me get back to the US and the global financial sector. What's the Morgan Stanley base case? One more rate hike, and the quantitative tightening, reduction of balance sheet continues by the Fed even if they stop hiking. So do you expect tight financial conditions in 23?
So I think, we should see the financial conditions continuing to tighten. And that's precisely what the Fed wants, because inflation is still somewhat high. And the labor market numbers you referred, the employment numbers that we got on last Friday, we're still at a point where they need to still maintain tighter monetary policy. But we're not expecting another rate hike in our base case. We think that they will get the data points, which will be allowing them to take this pause in a more longer-term manner, and then take a first rate cut in first quarter of 2024.
Okay. Now, the reason why I'm preparing this ground is to know how much of global headwinds will India face. We had this extraordinarily good Jan-March GDP number where the contribution from net exports was substantial. Will that weaken in the quarters to come? Should we worry about headwinds?
That will definitely be a headwind for India. We do expect that the services sector exports will follow what is happening in the US economy, and the US economy is expected to slow. While we don't expect a deeper recession, but it's definitely going to slow, and that will weigh on external demand for India and also for the rest of the region. Latha, there is a slightly different mix of exports that India has versus rest of the region, is that there is a significant dependence on services sector exports. And that tends to be a bit more defensive and not volatile.
That's the point, Chetan. Let me, sorry to interrupt you here, but you know, when China went through its great demographic dividend, irrespective of business cycles in the West, China became the manufacturing hub for the world and therefore outshone the global economy for a better part of those 20-25 years from the early 90s in particular. Now we have become the back office or the middle office for the world. Like you say, it's not just software at all. Audit has come to India, legal back office, risk, compliance, artificial intelligence. So much has come to India, which, as you say, could be defensive. So do you think we have a chance of outperforming even when the global economy slows?
That is right. And I think I wouldn't restrict that story just to the services sector. I think that's going to also happen in the manufacturing sector. And, in the manufacturing sector, we are expecting the market share in goods exports to double over the next 7 years. Even while we double, it would be 3.5% to 4% market share in global goods exports versus 15% for China. But that's going to be an important driver additionally alongside what we are seeing in the services sector. But the beauty about the services sector is that it's a segment which is growing faster than goods. So digitalized services are growing faster than goods globally, and India is able to increase market share within that segment. So it's kind of resulting into a supercharged growth for the services sector.
Okay, that's good to hear. Just one more near-term question. Do you see any rate cuts in India anytime soon? I mean, our inflation also is surprising on the downside.
I think that, to the extent to which the Fed is not giving a clear signal that they are done, that would be a factor that the RBI will have to consider because it has implications on the currency dynamics. And therefore imported inflation pressures. So we think that RBI will stay put and take up rate cuts in the first quarter of next year. Having said that, we are also highlighting that there is a upside risk, possibility that RBI cuts in the fourth quarter, with the Fed giving by that time a clear signal that they are done, and they could also be on the path to cut rates from first quarter. So I think fourth quarter is a possibility, but our base case is first quarter next year.
Okay, so the RBI is likely to cut rates in India only in the first quarter of next calendar year. That's the word coming in from Morgan Stanley. Get into a break. On the other side, we'll talk technicals. Chetan Ahya will join in.